So let's go ahead and talk about some accounting principles and some of the key things you need to learn. The very first thing is the accounting equation. I have already alluded to this equation, but now we are going to explore it just a little bit more. The accounting equation basically states that the assets need to equal the liabilities plus the equity. So when you look at the balance sheet, the assets must always equal liabilities plus equity. There's no exceptions. It must balance out. That is why it's called a balance sheet, because assets equal liabilities plus equity. So that is one of the key concepts. That is one of the most important concepts you need to know, is that assets must equal liabilities plus equity. Now, one of the reasons it's important to remember that is when we are looking at financial statements and we start to model out the financial statements, which we won't do in this course, but we do in our financial modeling course, it's a great check to know if you are doing things correctly. If you create a whole financial model and your balance sheet doesn't balance, well, then your whole model is wrong and something is screwed up. So it's a good check to know. But this is a fundamental principle you need to remember. Assets equal liabilities plus equity. Easy, right? Like I said, this is super easy stuff that we're learning. Nothing too crazy. So that's principle number one, the accounting equation. So let's go through an example. Now we are going to jump into a case study in just a little bit, and we will actually analyze the financial statements. But here are the financial statements that we are going to be looking at in just a little bit. We have this company. It's called Food and Stuff. If any of you guys are parks and recreation fans, Food and Stuff. Food and Stuff, here are their financial statements. Obviously not the real financial statements, but financial statements that we made up. So right here, we have all of their assets, and we'll go through each of these accounts in a little bit. And we have total assets of $94 million in 2017. Well, down below, we have their liabilities, which consists of accounts payable and debt and things like that. And then we have their stockholders' equity for a total of $94.1 million in liabilities and stockholders' equity. So when you add up this $55 million right here, plus this $39 million, you get this $94 million. And this number right here matches this number up here. So assets equal liabilities plus equity. It's true always. It's never not true. And if it's not true, that means something's wrong. That means you need to go back and tweak your model or do something because something's not right. But assets must always equal liabilities plus equity. So that's the very first fundamental thing you need to know about the financial statements. The next thing we need to know is double entry accounting. Now you might be thinking, Nate, you said this wasn't going to be difficult. Here you are talking about double entry accounting? That sounds pretty crazy to me. It's not. Let's break it down. Double entry accounting, all it means is every transaction that a company does involves at least two or more accounts. Well, I guess not at least two. It involves two or more accounts. That's better. So every transaction involves two or more accounts. So let me show you guys an example of what I mean. Let's say that you borrowed $25,000 from the bank. That means that your cash account, which is on the assets on the balance sheet, is going to increase by $25,000. And your notes payable, which is debt, or that's a liability, is also going to increase by $25,000. Now what that does is it balances out the balance sheet. You see what happened? We increase assets by $25,000, and then we increase liabilities by $25,000. So it sort of nets out, right? One increase and so did the other. So the accounting equation balances and it's all good. There's peace and harmony in the universe. So cash goes up by $25,000. Notes payable or debt or whatever you want to call it also increased by $25,000. So the balance sheet still balances. Like I said before, it's two or more accounts are always affected by every single transaction. So let's look at an example of where three accounts are affected by a single transaction. So let's say that you had revenue of $75,000 last year. Okay, so you sold your product. Let's say you sell subscriptions to MySpace, or you're like a MySpace consultant or a Google Plus consultant, and you sell $75,000 worth of services, and you've been paid $50,000. So your grandma paid you $50,000 to teach her how to use MySpace, and then there's $25,000 that's still outstanding. So you've performed the work worth $75,000, you've received $50,000, but there's still $25,000 that people still owe you. So you would record $50,000 in cash because that's what you received. You would also record $25,000 in accounts receivable because you've received $50,000 and you expect another $25,000 to come in the next couple of weeks or so. So those are both assets. So assets just increased by $75,000. Well, you'd also record $75,000 in retained earnings or stockholders' equity. Now, we'll go through this in a little bit, but within stockholders' equity is where we put the net income. So that's how the balance sheet and the income statement tie together, is you take your net income and you plop it at the bottom of the balance sheet in retained earnings is what we call it. And so we would put $75,000 in retained earnings. So cash goes up by $50,000, accounts receivable go up by $25,000, and retained earnings go up by $75,000. Therefore, there is peace and harmony in the universe. Assets equal liabilities plus stockholders' equity. We increase assets by $75,000, and we increase retained earnings by $75,000. So that's the second principle. Every time you have one single transaction, it's going to affect at least two other accounts. Now, this is extremely beneficial once again when you are modeling the financial statements, because if you show an increase in revenue, well, then you better be showing how retained earnings are increasing and how much cash you're receiving and the accounts receivable. You have to think about all these different pieces. So you can't just say revenue increases by $75,000 and then just leave it. No, your model needs to be dynamic enough to flow to every other piece of the model. And once again, we don't go through that in this course. We'll go through that in financial modeling, but it's a core principle you need to know is double entry accounting.